There are three methods of measuring national income. That is value added method or product method. Second is income method. Third is expenditure method. Before that, we will see once more how is national income calculated. National income, that is if the aggregates are given. National income means NNP at factor cost, net national product at factor cost, when GDP at market price is given. If GDP at market price is given, then net indirect tax is given, depreciation is given as money value. All these are given as money value. Then NFIA is given. GDP at market price value is given as everything in rupees. 1000. This is 100. Depreciation is 20. NFIA is 150. How can we calculate national income? We know that in order to arrive at NNP at factor cost, we know gross minus depreciation we will get net. Domestic plus NFIA we will get national income. Market price minus net indirect tax we will get factor cost. So we have to make it net national product at factor cost. From gross domestic product at market price, we have to make it net. The gross concept we have to convert it into net. Domestic we have to convert to national. Market price we have to convert to factor cost. So gross minus net. GDP at market price minus depreciation. GDP at market price minus depreciation, this will become NDP at market price minus net indirect tax. It will become NDP at factor cost. So GDP at market price minus depreciation, this will become NDP at market price. Now minus net, it will become NDP at factor cost plus net factor income from abroad, it will become NNP at factor cost. See, GDP at market price minus depreciation, it will become NDP at market price minus net indirect tax. Market price minus net indirect tax, it will become factor cost plus NFIA. It will become national concept, NNP at factor cost. So what is the value? GDP at market price 1000 minus depreciation 20 minus net indirect tax 100 plus NFI is 150. So 1000 minus 20, it is 980. 980 minus 100, 880 plus 150. 880 plus 150. It becomes 1030. 1030 rupees. It will be given in crores. Rupees in crores. Now whatever unit is given, that is to be added with the answer. That is a must. Okay. Sometimes NFIA will be given. Most of the time that factor income from abroad is negative value, because income to abroad is greater than income from abroad. So if it is negative 50 minus 150, what will be the answer? You can calculate. So first I am giving the method. Okay. So GDP is given GDP at market price is given. From that we have calculated national income. Likewise, we can calculate national income from each and every aggregate given. If it is NDP at market price given, there is no need to deduct depreciation, because net domestic product at market price, it is given by deducting depreciation. So we will start the problems now. While doing the problems, I will explain each and every concept once more. And so please watch the next video. It will be given as a series. This will be in the calculation. This video will be the first one. Then second, third, that way as a series it will be given. Value added method, income method and expenditure method. Before we start the calculation, kindly refer circular flow of income. And national income is, simply we can say, it is the aggregate flow of, national income is the aggregate flow of production. It is the aggregates you have seen now, because each and every, it is the total money value of all the final goods and services produced in a country in an accounting year, and the goods and services, they are measured in different units, kilogram, liter, or centimeter, meter, or just in numbers. So the money value is taken of all the goods and services, otherwise it cannot be calculated in a proper form. So aggregates. So national income is the aggregate flow of production, that is the total production of goods and services in a country. Aggregate flow of production, or it can be expressed as aggregate flow of income, or aggregate flow of expenditure. Here we mention the circular flow of income, that is aggregate flow of production means goods and services are produced by using factors of production. Which are the factors of production? You have learned that in the theory part already. Land, labor, capital and entrepreneurship. By using land, labor, capital and entrepreneurship, goods and services are produced in the economy. And while these factors are helping for the production of goods and services, they derive an income. The producers are giving income to these factors. All the income, it goes to the household. The firms are getting income, households are getting income. But these factors of production, land, labor, capital, entrepreneurship are coming from a household. So household is providing this service to the production units. So factor inputs, their land, labor, capital, entrepreneurship derive an income. Land gets rent, labor gets wages or salary, capital derives an interest, and entrepreneurship or entrepreneur gets a profit. So rent plus wages plus interest plus profit, the total factor income. Rent, wages, interest and profit, this factor income. This is the income received by the factors of production is called factor income. By rendering the services in the form of land, labor, capital and entrepreneurship, the factors are getting an income. This income is used, or we can say, use the word spent, to purchase the goods and services produced. So the production happens by using the factor inputs. The income goes to the household. So production generates income. How production generates income? Production is done by using factor inputs. These factor inputs are getting an income. So production generates income. This income is spent again on these goods and services. So this income is spent means it is the expenditure of the economy. It is spent means it is expenditure on the produced goods and services. So it is a circular flow. It is continuous. So we can prove that the total goods and the money value of the final goods and services produced in the country, its value is equal to the total factor income generated is equal to the total expenditure incurred. That we can prove. Okay, that is the total production in the economy as goods and services, its value is equal to the total factor income generated is equal to the total expense incurred. That means this income is spent to purchase the goods and services. So the value of the goods and services produced is equal to total factor income generated is equal to total expense, that is a purchasing power. This income increases the purchasing power of the people. So the disposable income, this is the disposable income, the income with the household to spend as they like. Okay, so that value of the goods and services produced, this production generates income and this income is spent for purchasing the goods and services. So we can prove through national income accounting, it is actually the national income is measured in these three ways: production or value added, factor income, expenditure. Three methods. By calculating in three methods, you will get the same value of national income. This is what we are going to do through the problems. We will start with the value added method first. Value added to the goods and services, otherwise called product method. Kindly watch the videos. It will be given as a series. First value added problems, then income method, its calculations, then expenditure method and reconciling all the three methods. Thank you.